Good afternoon, everyone, and welcome to a Stock Market Today episode for August 16th, 2024. And since this is a Friday, you know what that means. It's an extended episode with Mike Webster, our senior market strategist. How you doing, Mike?
Good, Allie. How are you?
Yeah, well, thank
It's
you for
Friday.
noticing. Yes, I am not Allie. Allie is on vacation, much deserved. She's doing that thing every now and then, but I'm here to kind of walk us through. And man, what a day to kind of talk about things because on these extended versions, we also take a look at the week, kind of how things transpired. And this week is a very different sentiment change from where you and Allie were talking last week. So that's definitely something that we need to cover. And of course, we've got some stocks to cover. What do you have for us this week, Mike?
I don't know. I gave them to you.
Right, okay, I've got you covered. You're going to go ahead and do Ferrari, Costco, and DaVita for the
Right.
renal care, and those are the ones that we're going to cover. But first, let's talk a little bit about where we ended for the day on the market. We had the Nasdaq Composite looking like it was up about 0.2%. The Q's about the same, a little bit less, with a 0.1% gain. S&P 500 0.2%. Dow Jones Industrials 0.2%. I'm catching a theme here. The Russell 2000 also up 0.3%. But what was really kind of noticeable was the gains for the week. I mean, this was one of the strongest gains that we've had for the entire year. The Nasdaq Composite up a whopping 5.3% at the close here. S&P 500 was for the week, it was up about 4%. So a very big difference from how we were looking last week, especially last week on Monday when we had so many things hitting us. The yen carry trade, Google antitrust, recession fears. 50 basis points might not be enough in September. We might need an emergency meeting, kind of a sky is falling type of situation. So, Mike, let's pull up the NASDAQ and start there. What changed?
Wow. I think it was the sky didn't fall.
Yeah.
And it was, it was one of those things where, it's easy now to look back and say, the Monday morning gap down was the perfect buy and that's where you should have bought. But the reality is you didn't know at that time that the sky wasn't falling because there were so many things happening at the same time. And we talked about it a little bit on IBD Live this morning with David Keller, who was a great guest. And anyone who uses or is subscribed to IBD Live should go back and watch that show if you missed it. He was great. And if you don't subscribe, I would subscribe just to rewatch today's show. We went over a ton of stuff. And one of the topics was,
You can always get a trial at investors.com/IBD Live.
there you go. And I think it's pretty cheap. So what happened is all of those things happen over like a 2 to 3 day time period. At the end of July, we had the Fed meeting. We had the follow through day on SPY that day. The next day, all this stuff started unraveling between, one by one. It was Google and it was all the things that you mentioned. But the biggest one was everyone was thinking that we needed a surprise cut right after Powell had just kind of locked himself into this quarter rate cut cycle. That's what he was. He never comes out and says anything, but you have to read between the lines, and it was about as clear as it gets that he was going to do 3-quarter rate cuts later this year. Then, within 24 hours, people were calling for an emergency rate cut of 50 basis points just to get the ball rolling. So that caused a lot of havoc. The unknown of the yen carry trade unraveling, was that going to knock some hedge funds out that we're going to just have to, be forced to liquidate, which could have dragged the market lower. So you don't know at the time. So don't go back, don't look at this and go, okay, the next time the market falls like that, you're going to step in and buy, because they don't all work out that way.
Yeah.
And all you have to do is study history.
And I mean, the 200-day moving average line, I mean, that's an area where you really want the indexes to get support if it comes down to that level. So yes, it was great that it did, but you didn't know that, it could have easily just rolled right over.
Yeah, let's go to the S&P, because that's even more important, in my opinion, because of that 200-day that you mentioned, that we tend to focus on the NASDAQ a lot, but the general market, most participants focus on the S&P because that's the bogey for professional money managers. And, that's really where everyone spends most of their time analyzing stocks. And in fact, David had mentioned that today, that, that's the first thing he does, and NASDAQ is secondary. And that's just kind of normal for the industry. And so a retest of the 200-day, frankly, would have been normal. So, we didn't get there on that Monday. And so coming back down, that would have been normal and natural and what you would have expected. So what happened? We had a major kind of week-long expectation breaker where the market just kept getting stronger and stronger throughout the week. And most importantly, our low got back above the 50-day on the S&P yesterday. That is a big deal. A low, getting the close above the 50-day is one thing, but it's really, when you're looking at moving averages, getting the low above a moving average and closing up on the day, that's very significant. That's saying, hey, we retook this level and now the bulls are in there and they have to defend it. It doesn't mean that we can't come down and test it, but they've, 2 days with your low above it. That's a really, really big deal after what we just got hit with. So stepping back from this and looking at what's transpired over the last 3 weeks, you had the follow through day on the S&P there on the 31st. Then you had your expectation breaker. Then we came down and bounced up. Now we're right back up to the high of that expectation breaker. So I'm looking at this as in the spirit of a double bottom, where we had our first bottom, drawing down and then up, in the high of the expectation breaker is your pivot point, or the middle of the double bottom. Some people call it a W formation. It's both the same thing. That is your pivot price, the important price to get through. And at that point, that's a buy. It's already, we're already in the market, and our market school rules that the two of us came up with, along with Charles Harris, who you had on the podcast this week. Looking forward to watching that. How was that?
Oh, it was great. He's, he definitely, for as great as he's done on some of his market returns, he's still suffering drawdowns, and the psychology that goes behind it. It's very insightful. What he brings to the table on the psychology end. And I mean, that he was doing the psychology aspect for, 10 years at the level 4 master's classes with Bill O'Neill in Santa Monica. So yeah, great stuff. But back to the task at hand.
So this is a double bottom formation as we're looking at it. Not exactly, it's not textbook by any stretch. The second bottom is much further down than the first bottom, which is not something you'd like to see. And it's not really as long as you'd like it to be. Typically, you want it a few more weeks longer, or about a week longer, but it is what it is. That's the type of formation you have. And so rather than being scared that, we've come up and we need to come down, we don't necessarily need to come down. I would like us to come down, but I would have liked us to do a lot of things differently than we had in the last week. So we'll get into some historical examples in a little bit.
Well, and before we move too far, I want to just, point out that one of the things that kind of changed everything was this follow through day. And one of the things we didn't like was that it came on Tuesday. Granted, there was a PPI report that, looked pretty good there, but we had the CPI report the next day. And who wants to step in front of that train, especially the prior week when there were so many recession fears and things like that? I mean, it's great that inflation is coming down, but on the other hand, hey, did you go too much, or did you wait too long to reverse your hikes? And that's been the fear for a lot of people. Can they really nail the soft landing?
Exactly. So, I know where I was thinking about when about the whole market school thing is from that day that you mentioned. Prior to that, using the market school rules, which I know 99% of the folks listening don't know what they are, but it's just a count that we have from 0, which equates to being out of the market essentially, up to a +5, 6, or 7, which all equate to 100% invested. So you basically go from a 0 to a 1 when you get a follow through day, which is what happened there. Then we get more counts depending on different rules that the three of us came up with. So the next day, our low got above the 21 day and we closed up on the day. So after the follow through day, you went from a +1 to a +2, which would have been that whatever day that was, Wednesday. And so 30%, then to 55%. And then yesterday we had two signals. We had a subsequent follow through day, which is something the three of us came up with that during that work, basically saying after you get your first follow through day, the other ones within the first 25 days of your low or your rally day, those count as well. So that there was a +1 for that. That put us at a +3, which was 75%. And then on top of that, our low got above the 50-day and closed up on the day. And it was the 50-day wasn't in a decline. So that was another signal from market school. So essentially we went from 0 coming into the week to a +4 or 90% speed limit for market school. So those are just black and white rules. And I like to lean on those when, especially at times like this, when you're seeing stuff in the market that you don't want to have happen. We really didn't want all this strength, but we got it. So then that's the time to lean back on your rules that the three of us tested, and they're not perfect because nothing's perfect, but it's the best thing out there as far as I'm concerned. So we're at a +4 or 90% speed limit. Doesn't mean you have to go 90. It just means that's, if you're far away from 90, then really look at everything and see if there are things to buy and you want to start getting to that target. Now, if we close below the 50, below the 21 day, get a bunch of distribution, that count will be reduced and we would start backing away. And one of the big lines in the sand is the low of the follow through day. A close below that, and pretty much all bets are off, and then you're backing away very quickly.
And the reason is because that failure rate, and what we consider rally failure is when you undercut the lows of the rally. Certainly, if we get below that, it's as you said, all bets are off at that point. Should we, before we kind of go into the sector spiders and stocks, should we do some historical examples, you think?
Whatever order you want. You're driving the ship.
I'm driving the ship. Oh yeah, I'm drunk on power. But yeah, let's go ahead and we'll start.
Please don't hit an iceberg.
Right. We'll start with going back to 1985. Do you want to keep on the NASDAQ for these?
Yeah, let's switch over to the NASDAQ for all of those. Yeah.
Okay. So this is back to 1985. I just recently watched Back to the Future, so of course, just a few days later was the important November date. And what are we looking at here?
Okay, so one of the homework assignments that we gave on the show recently was to look at times where we hit new highs and then came down and tested your 200 days. So we're going to go over a select few of those right now that are relevant to our current market. So all these are ones that hit highs and then came down under the 200 day or near the 200 day. So you hit at 307.89, then you came down to your 200 day, which is your black line. That's a serious guardrail. And you undercut it a bit. Now you came back up quickly. So then let's see what happens at the next date.
So we're going to go up to 1023, just a little bit further.
Yeah. So really on that 2 days before that, on the 21st, that was the day that you would have expected the market, a normal and natural reaction after having that many days up in a row would be what? To pull back in, test your 200 day, test the green line, which is your 21 day. And that didn't happen. So I'm looking at this as a positive expectation breaker, meaning what was normal and natural didn't happen and you had more strength. Sound familiar? Kind of like what we just had this week. And let's go out to the next date on there. I think it was March 31st, 86.
Yes, thank you.
Okay, and
Okay,
that's
so just to orient everyone, this was the high we were talking about, and this was the area that we were just talking about right here, and getting back about that 50-day.
yeah. So the reason why I wanted to go over these today was to show for everyone who's out there saying we have to have a pullback, we must have a pullback. These are some examples where that didn't happen. And the importance here is the low staying above the green line, the 21-day moving average. That's your sign that the longer it can stay above that, the more aggressive you want to get. So if you were waiting for a pullback on there, you pretty much miss this whole rally. Some people these days call it a lockout rally. You can call it whatever you want. It is. I just focus my eyes on the low versus that green line on there. So
Mhm.
we're going to go out to the next one.
Yeah, let's go to 1990. So jump ahead a little bit. And this will be in January 11th, 1990.
Okay. So again, you were at new highs and you came down, you got a hit underneath your 200 day, and now you're coming up and you're having your normal thing where, at this point you don't know what's going to happen. This is a normal pullback, the pullback that you would have wanted. And now let's see what happens at the next date.
And that is just at the end of the month. So we'll flip over to January 30th.
So the pullback you didn't want,
Right.
the pullback that keeps going. So that's why, again, focus in on that green line, the 21-day. Are you able to stay above it or not during the recovery? Once you get underneath that, doesn't mean that it can't bounce and come back, but that is certainly your time to get very defensive very quickly. And of course, it closed back below the 20 or the 200-day as well. And that was significant.
And in this case, it should be commented that not only was it the green line, the 21-day moving average line, it was also the red line, which is the 50-day moving average line. So you really kind of got multiple signals there, a big warning that, okay, something is amiss. And it bears repeating here. We look at a lot of history that some people are like, well, why does this matter? This is in the past. And we use these lessons and these examples to kind of help us determine, what's happening in the present. And believe me, folks, it is not perfect. There is no one out there that can say, hey, this is when you should be all in. This is when you should be all out. We try and, do our best in terms of not getting hurt a lot when the market comes in. And that means that we're going to miss some of the bounce. That's just the sacrifice you make. You can't have it both ways. But by staying out of some pretty dramatic drops like the 2000 dot-com crash, the financial crisis in 2008, even COVID, as short as that was, kind of not taking that drawdown all the way down can really kind of put you in a better position to take advantage of, really growing your portfolio if you just don't take the big hit. So again, nothing's perfect out there, but this is also why we kind of go incremental. You kind of build your positions, you build your portfolio, you get back in a little bit at a time, and you're using the market as feedback to get you back in, which is absolutely critical, to use the market as your feedback, not your opinion, certainly not the headlines, because a lot of times, I'll be honest, the headlines will completely steer you wrong and give you a lot more fear than is warranted based on the chart action.
1000%. Let's go out to just like October, November of that year to the point that you made. And, look what had happened. I mean, can you even see where we just were on the chart over there in January? If you can point to it, January 11th, I think, which, over there. And look at all this damage. And there was a little trending above the 21-day there in May, and if you would have just focused on the low versus your 21-day and captured that part, you would have gotten, pretty much all there was to get out of that rally. Then just paying attention to the 21-day, especially when your high is underneath the 21-day that you saw really from July until this time. that alone will just save you from getting really hurt bad. I guess we can
Mhm.
skip up to 98.
Yeah, let's take a look at that. And you and I both remember this very well.
Mhm.
I mean, this is just a year into when I had started, and I remember we had a follow through day here, and I bought very heavy there, and was like, okay, here we go, I'm ready, with my whole $2,000-3,000 at the time, and then it rolled over, and I'm like, well, when the follow through day came the next time, I'm like, well, I'm not going to do that again. I learned my lesson not to trust a follow through day. And of course, this was the one that I really should have been in.
Yeah, and but what a lot of people don't realize is how many follow through days fail. And you ran some stats for us earlier this week that depending on how you slice it, about 50% of them will fail. I mean, there's a million ways to slice it, so a million different percents you can get, but a large number of them end up failing. That doesn't mean you don't use them every time. It just ends up giving you an expectation to trade against. So let's point to, what was the date? The 27th on there.
October
October
27th.
27th. And yeah, that day, or actually, you can even go, that day or the other downside reversal you had. Yeah, that one was the one I was thinking of. I think I put down the wrong date. That you had that downside reversal at that point, your expectation of your first one there, that you would think that you would go down for 2 to 3 days. You have a big downside reversal as you're coming up against a declining 50-day. That's a sign that you are basically what's normal and natural is for you to pull back 2 to 3 days minimum. And this one, the very next day was up, and then the following day it took out that high. I look at that as a positive expectation breaker. And then that second one you pointed to, same basic thing, that
Mhm.
the market should have come down, would have been normal and natural, healthy to come down, and it didn't go. It went straight back up. And so let's go out and see what this did out to like January of the following year. And that was a monster run, and there was a lot of money to be made. Bill O'Neill, the founder of IBD, made a ton with Schwab and AOL.
Over
During
400% in 6 months on both of those. So,
not
um,
too shabby.
and it's also worth remembering that, what was going on at the time. Long-term capital management, a firm filled with geniuses, I mean, Nobel Prize winners, literally. And they had done a miscalculation, on an event that they didn't think would happen. They were, you had the Russian ruble, a default, you had Southeast Asian currencies in turmoil, all of these things. And with their leveraged positions, it was, it wasn't a matter of, okay, are they going to make it? It was like, okay, who are they going to bring down with them? So that became the biggest issue. And of course, Warren Buffett and others were, proposing a deal here in September. And then, that didn't end up happening because the principals were like, wait, we were worth billions. How can you offer us just like 250 million? And when that deal didn't go, didn't happen, they ended up having to get Alan Greenspan, who was the Fed chairman at the time, to step in. So it was really, really quite messy. But
And just
let's.
while you have this chart on there, the break that you had over on the left, where it was coming down to the 200-day the first time, where it hit 1751 in August, that over on the left in like July, August,
Oh yeah.
1751. That area, that's kind of like what we just had this past week, where you could have thought, okay, the whole yen carry trade, it's it's not a big deal. The whole possible hard landing, all this stuff, it's no big deal. It bounces a little bit, and then the news really hits. So just keep in mind, you're not out of the woods until you're out of the woods. Like we're as long as we stay above the 21-day, we're out of the woods. But if you come back down in, you've got anything can happen. So we can go ahead and skip to the next one.
And a book that is on my radar for folks, When Genius Failed, which kind of does talk about that time period. So something you might want to check out. Speaking of another time period where the geniuses were having some trouble, we're going to go to 2007. And this is something that I didn't realize at the time until you suggested this book, The Quants, for me. But in August of 2007, there was quite a bit of turmoil among the algos, and some of these, again, really smart people that had come up with these algorithmic trading, members of Citadel and what have you. And man,
And
there was
AQR, yeah,
there was some damage done.
yeah, that's a great book, The Quants. Everyone should, well, not everyone should read it. You have to be like, it's a little bit dry. I loved it. So I don't know, give it a shot. So this was this quick from the highs down underneath your 200-day, again, reminiscent of what we just had. Now, this retest of the 200-day was normal and natural. That's what you expect when you snap back the way that one did, as quickly as it did. Now let's go out to the next date that we had on there. I think
just a day later.
Yeah, oh, that's right. So this was your positive expectation breaker. So when you have a day like the day before, this huge spread, gap down, goes underneath your 200-day, what would have been normal and natural would have been a gap down, upside reversal if it was going to work, not a gap up, go up near your highs. That's a tell. That's telling you that just like if you're playing poker, it is giving you information that the market is much stronger than what you think. Doesn't mean it's going to work out, but it is, the tells are what you're after. So let's look at the next date and see what happened.
And that was going to October.
October 5th. Yeah.
So we'll fast forward a little bit. And this was such a powerful time period. I remember you were absolutely killing it in the firm portfolio at the time. And it had been a tough year for a lot of people. The Shanghai surprise back here in February, and just a lot of the rug getting pulled out from under you. And September and October were great times to be in the market.
Yeah, some of the best. And Charles did extremely well during that time. I was fortunate to have some leaders that I played very aggressively during that time, and it worked out. And then of course we know what happened. It topped on October 31st, and then we had the terrible bear market till 2009. So we can go out to 2014.
And we might have to skip ahead.
Okay.
So after this one, we might have to go to the Brexit example. But yeah, for 2014, here we are at, let me go forward a little bit, 1022.
Okay. Yeah, same thing. At this point, you've bounced up. You're expecting it to go much lower. Let's go out to the next day.
And that would be just a day after.
Same thing. So you're seeing this theme, positive expectation breaker. Let's just jump out to February of the following year, just to speed through these. And you can see that nice recovery from where we were. It went straight up to new highs and beyond. So let's jump to the July of 16.
And remember, this was the election happening for the Brexit vote. And the market really had kind of looked at this as a non-issue. In fact, I believe this was kind of follow through day action right here, the night, the day before the vote. And then the vote happened, and man, that was a brutal 2 days.
Yeah, it was brutal, and it could have gotten a lot worse, but then the market was able to absorb the news, kind of like what we just had. And that's why we're going over these examples. It looked like the market was going to just fall apart, go all the way back down to the 4,200 level from earlier that year, but it snapped back. It was the market is always right, and it was able to see what was around the corner. Let's go out to the next day. And there was your positive expectation breaker. Now, it did go lower in the morning, so it kind of not a classic expectation breaker, but still you were expecting further weakness. And let's see what ended up happening. We can go out to August 5th, I think. Or yeah, we can jump there. And you can see how that bounced back, and no one would have expected, that type of move. And again, focus your eyes on when the low gets above that green line, that's your sweet spot. That's when you really want to push it.
Hmm. Yeah. And you know what? Let's go ahead and just for recent history,
Sure.
let's take a look at just one more. And this is going to be uh, the most recent follow through day that we had, kind of November 1st. That time period was that follow through day. And we'll just go to, let's see, November 10th. So we see a little bit of action afterwards.
Yeah. So the day before, again, that same setup where you were thinking that you should come down and test on that day. If you were analyzing the market, you'd say, okay, our expectation is to come down at minimum test the red line, which is your 50-day, but most likely test the green line, which is your 21-day, normal and natural. Then the next day you get your positive expectation breaker, probably because it was my kid's birthday. That's what my best guess. And let's see what happened. And yeah, so they got a birthday present and it went up, and that was your positive expectation breaker. Now let's just jump to current day to see the whole point of everything that we were going through. When you broke down the way that we broke down, your expectation was spending more time chopping along and just marking time at best, staying underneath that green line, the 21-day. You wouldn't have thought, given the news that we had 2 weeks ago and how so many charts were broken, that you would have had this type of reaction. So I look at let's look at the week on here as a positive expectation breaker, because yes, we had the upside reversal last week with the assumption is to move higher, but not 5% higher after the type of break we had.
Right.
So it's just a reminder to always stay flexible. That's what Bill O'Neill taught us to do. And, to never plant your flag in the ground and say, we're in a bear market now, everything is topped and we're going to go lower. You just bend like a tree in the wind.
Let's take a look at the stocks that you had, and then we'll kind of circle back and look at some of the sector spider ETFs. And why don't we start with race? Because man, when you are racing ahead in the market, why not, look at Ferrari as an example. And I do have a position in this. We also have it on Swing Trader. I believe it's also on Leaderboard. What was appealing about this one to you?
Yeah, I have a position in it as well. Let's look at the weekly for a second. What I like about it is this long, tight base that it formed. And can you just show how deep that base is? So 10% deep, and then look at the last two bases, the depth. So 11, the prior one 14, and then that big one at the bottom, 40%. So that's exactly what you want to see. You want to see bigger bases, then getting tighter and tighter. What that's telling you is that the market is more at equilibrium. The bulls and the bears are kind of in agreement at a certain price level. Then you just wait for either a breakout, which we buy, or a breakdown, which if you're on the short side, you would short. So we were just waiting for that, and it was setting up. And I think I mentioned I bought it as well after we put it on Swing Trader, and it looks solid. Worst case scenario, it comes back in. Worst case scenario is always a gap down to zero. That's always in the cards for anything. But typical worst case scenario would be you come down and you fail. This breakout fails with on a gap up that we had on Wednesday. If you close underneath that low of Wednesday, then I think you back out of this trade and just chalk it up as a failed breakout, which happens. They happen all the time.
Now, even before the follow through day, we actually put Costco on Swing Trader. I do have a position in this myself. This is a little bit slower. It's not your race car Ferrari, but sometimes slow and steady wins the race.
Yeah, I bought it as well after we put it on Swing Trader. It was making it back above the 50-day. It was a tight base, and this was one that I would have felt comfortable with even if the market kept rolling. And at that time, I thought the market was most likely going to be in trouble for some time. I mean, that's the reality. So this will probably slow down your portfolio, but I still think it's worthwhile because we don't know what's going to happen next week or the week after. And so this is a slow, steady stock. Let's go to the monthly on there. This is one that you can sleep with at night, because people aren't going to be, you're not going to have 100 million people canceling there, or however many people belong to Costco, all those people canceling overnight. And that's what, Costco makes their money off of, all the annual membership. So looks
and they
good.
just raised it, what, $5 for the standard membership from 55 to 60. I don't know many people that are balking at that.
Yeah, and you got to go with the executive one, because then you get your 2% back.
Yep, I just got my check myself, so and it paid for the membership.
That's all you can ask for, right?
Yeah. So, yes. And let's go ahead and take a look also, because not only have there been some of these more defensive, slower names, but healthcare has been, we'll definitely be looking at healthcare in a little bit. But DaVita is in that space. And whether it's, David Ryan on IBD Live was talking about kind of some of the hospitals and the long-term care. This is outpatient for renal disease. And a nice little base that it's coming out of here. Another one which didn't really correct all that much.
Yeah, I have a position in this as well, and I agree.
As do I.
Yeah, I agree with David Ryan's take on those sectors being, pawns to fish in. I think it makes a lot of sense, and he was early on that, so great job with that, David. And so this one, as I was going through the 145.38, that's really where I should have been buying it. I was just buying other things at the time, so I was, waited for the normal breakout to happen. But let's look at the weekly on this one, and it reminds me a lot of Ferrari, even though it's completely different, right? Completely couldn't be more different than Ferrari. But that big base at the bottom, a tighter base, and then a tight flat base that it's coming out of. So again, it's more of a safety type of play, all three of these, because even though they're all different businesses, the downside to them is a lot less than many stocks out there, because you'll know where you're wrong. And with this one, let's go back to the daily. I would know that I was wrong on this one if it takes out the lows from if it comes back into the 145.38, then, then it's time to back out of this. In my opinion, and then just wait for a new entry. So that's the way I'm approaching things, is looking for things where I know the exit is relatively close, rather than just buying something that's snapped back and is really extended, and it could fall 10-15% before you know that you should exit.
Very important that all of these examples, you have your line in the sand of where you're getting out, because nothing says that these have to work. Nothing says this market has to work. We kind of put our chips out there, and if they aren't working, you got to try and save what you can so that you don't get wiped out. Let's go through some sector spider ETFs, and we'll start with the top group for today, financials.
Yeah, so when we do this, we'll do this rather quickly. Just focus your eyes on the green line, the relative strength line, to see where what's outperforming the market. So this is still above its moving averages. So I would still look in this area. I think Berkshire looks interesting in this space, but we can move on to the next one.
XLU actually took the second spot today.
I don't like the RS line, but I like the price action. So it's one of those things where, since the market's been ripping, no one wants utilities, but this is still holding in there. So if the market rolls, this one still might work. So if I were doing this one, I would probably, there's a few, individual stocks out there that look good, like an NEE that I have a position in, but I think you're just better off just going with the XLU. A broad-based one.
Let's take a look at XLC.
And that's looking interesting as well, the price action, but the RS line is still underneath its moving averages. So besides Meta, I would, which Meta looks interesting, I would stay away from this group.
XLP, the consumer staples.
Solid price action, terrible RS line. So I would still look here. So that's a lot what's going on this week, but it's fine. Sometimes absolute price action is fine, and it looks good. I would look in this space.
And the consumer discretionary.
Looks weak. I would stay out of that space.
XLK tech.
I think you're better off with just Qs if you're playing this space right now, or maybe an SMH type of thing. But the RS line is poked back up. It's come back up to its moving averages. So worth looking at that space.
XLB materials.
Price action looks weak and the RS line looks weak. So I look elsewhere.
XLV, we talked about healthcare.
Yeah. Again, that RS line, kind of like the XLU, it looks terrible, but the price action looks good. So this is a space to pond efficient.
XLRE, the real estate.
Broken record, same thing. It's holding in there tight. Just no one's been interested the last few days because everything else was ripping. But I still think this is a good pond efficient.
Energy, XLE.
Avoid.
Wrapping it up, XLI, the industrial.
I'd avoid that as well.
Okay. A couple other things to just take a look at. GDX and the gold miners for some a little bit more specifics, drilling down, if you will. What do you see here?
Yeah, to me, I have a position in this. We put it on Swing Trader. I look at this as an irregular double bottom that it just broke out of today. It's too short to be a normal double bottom, but the middle of this little formation as your entry point. So as long as we stay over yesterday's close, I think that this trade is still intact.
And just a quick look at the software sector.
Yeah, so this is interesting in that it's kind of in no man's land. The RS line is just sideways, but yet the price action has been moving back so nicely. And this is, of course, in a space where I was very, fixated on, a month and a half ago, really thought it was going to lead the market, and I was wrong. And now it's breaking this downtrend line that you can see, and it broke that, yesterday and a little bit the day before. So I think this is a space that you should look through and see if there's any worthwhile stocks.
How about SMH?
I have a position in SMH. I think a lot of them have bounced back. They're very irregular looking double bottoms. I'd say the best looking one in there I don't have a position in is Broadcom, AVGO. And to me, again, this looks like a double bottom with 177.10 as your pivot, but it's already looks buyable. You don't have earnings for 20 days, so it gives you a little bit of a space there, but it also looks like it could go sideways for 2 or 3 days. So I don't have it yet. I'm just waiting for a little bit better entry on it. But of all the semis, I think this one looks the best.
So Mike, are you ready to kind of kick it into a little bit of the regression lines and your Webby RSI?
Yeah, just
we'll
let me
pull
know.
down this chart and we'll switch over to yours.
Okay, and I'll try to be quick because I know we spent a lot of time on that historical stuff. So this is our Bob Weir take a step back. At first, we're just going to focus on SPY just to speed things up rather than toggling back and forth between NASDAQ and SPY. Here's our weekly chart. We had this nice trend from last November up until early April when it broke that trend in these regression lines. And we started a new regression here that was very tight, and then that fell out of it in late July. So now we're snapping back. Two big candles, positive candles, where your open was down here, your close was up here, open was down here, close was up here. You cannot ask for more than that. What you would like to see is things settling down a little bit, but don't expect negative weeks in there, because when a trend starts, lots of times you get a lot of these positive bars in a row. You have 1, 2, 3, 4, 5, 6, 7, 8, 9, if I counted that right, 9 weeks in a row where your close was higher than your open. We could certainly see something like that. Let's go over to your daily chart and your regression. And this is a thing that you were pointing out. You were asking me, where do I like, because regressions are really an art. And this is just a line of best fit. In this case, it was from our first date was April 22nd. And then we go out, I like to go out 50 days and stop it. And that was, I stopped it on July 2nd. And then you can see that on July 24th, we broke through the bottom 1 standard deviation of that regression. And so that was telling you that things were changing, and they sure did change. The times were changing. And then we fell apart, and now we snapped right back. If we were to draw a regression on this one, oops, hold on. I'm having trouble drawing. My things have gone away. So I'm not going to draw a regression on there, but you could just see that it would be too soon to draw a regression. Even next week would be too soon, because that line would just be straight up in the air. So we're going to skip that, and we're going to move on
So I know you said that you want the 50 days in order to kind of have the 50 days between your anchor points, but when do you start saying, okay, I can at least start my regression line?
About 21 days or so.
Okay.
About 21 days, and we're still, kind of early on in there. It's an art. It's also, if you were drawing it, when we draw it, I'm going to start it on August 5th, our down day. And, basically it would go right now, our regression would go straight up to, it's unreasonable, because that would, basically say we're going to the moon, in 2 or 3 months. So that it's not possible for that to happen. So there's a bit of an art, but typically, 21, 25 days or so is enough time to start getting a sense for what the trend is. And I like stopping it at 50 days.
Mm-hmm. Let's go ahead and take a look at some of your retracement levels too, because that's an important thing.
Sure. So here's the 50% retracements that we went over last week. The first set are starting with the Friday before the gap downs close, then going to Monday, that ugly Monday's low. And, the red line here, the 521.59, that was your midpoint. And again, with this 50% retracements, we're always looking at them at various time frames and then seeing when can you get above them. And once you get above that line and you can stay above it, it's a sign of strength, and it's a sign that trend is changing. So we had that around here. And even though it was hard to believe that the trend was changing, indeed, this is why we use it, to give you some more confidence that, hey, you're getting back up to your old highs of where you started it. So you did a full retracement. Now let's slice this a little differently. And we're going to go to the height of the expectation breaker, the August 1st high, and then using again the same low, the August 5th low. And we came all the way down there. Our midpoint was 532.57. That was your 50% retracement of that time. And so you knew that here on the 13th, on the follow-through day, that's where things were changing. You were starting to live above that midpoint, which was very significant and frankly, very surprising. And of course, you made it through your 21. Now let's look at it a different time frame. This is going all the way back to our highs that we hit in mid-July, July 16th, same low. And again, we're back over that area. So, I should probably shade the top green and the bottom yellow, and, where you're cautionary below it and, it's positive above it. So you're in this green zone up here, and that is your safety area. So a line in the sand would be, to start getting defensive, would be the 537.72, which corresponds with pretty much with the low of July 25th. So it would be normal to come down and test it. You just don't want it to live underneath there.
It's funny how sometimes you get those logical places. It's, you think, oh, 50%, it's arbitrary, but then you find a level of support. It's like, wow, that just is right, right at a logical level. By coincidence, or maybe not coincidence. Let's also just chat real briefly about the. Did you want to show one more?
Yeah, let's just show the levels. This is something I do every week. I do the levels in the 21 day. I didn't change any of these from last week, but we just wanted to recap of seeing where we were and how things have changed. Now we've gone through this line, and now we're up to this line up here, which was the August 1st high. I am shocked that we were able to bounce back through that many levels so quickly. And let's just look at the NASDAQ composite. Same thing here. Last week we're down here, and we go through this level, made it through this level. So these levels on the chart are just things lines you want to keep on there to just make note. Are you making progress, or are you falling back? And you just don't want to fall back. You can go 2 steps forward, 1 step back, but you don't want to go 2 steps forward, 3 steps back. And we'll just finish up on this chart. Just very simple, always looking at the stock or the stock or the ETF and its 21-day to just keep things as simple as possible. If you don't look at anything else, look at this one. And when your low is above it, all things are good. When your high is underneath it, all things are bad. When you're in between it, that's the chop zone. So right now, all things are good while we stay that way.
Yes. Well, hey, Mike, really appreciate you walking through this. Again, I think the learning lesson from all of these examples, these historical examples, are not that we know exactly what's going to happen. Nobody does. But you've got to have some scenarios built in place of, okay, here are some examples of what's happened in the past, and how does this help me kind of get a little bit further in my own portfolio and make progress and reduce those drawdowns as much as possible. Now, one final thing, did you want to bring up the RSI, your Webby RSI? So this is, again, just for folks that aren't familiar, it's not the relative strength indicator. This is the real simple indicator. You mentioned how important the 21-day moving average line is, and this is basically where are you at in relation to it.
Yeah, and we'll just go over this quickly. This is expressed in ATRs. So our sweet spot is half an ATR to 2 ATRs. So from here to here, that's the area that you like to be in when you're trending. When you start a new move or you're in a recovery phase, that can get higher. So this could certainly get up to the 3 area, over the next, it's hard to believe, but it's possible over the next week or two to get up there. I prefer it not to, but it's going to do what it's going to do. But later in a trend, you don't want it to get up to those high levels, because that's kind of a warning sign. So now that we've, and again, this is just measuring your low versus your 21-day. What's interesting is on, hold on a second. I had a user error. On this one, on the NASDAQ, it's interesting to see how well the Webby RSI worked near the highs, and why we were, starting to get worried up there is near the highs, our low versus our 21-day was up at its peak, our danger zone of 3 ATRs, starting there on July, what is that? It looks like July 8th. Mm-hmm. Yeah. So on that day, as well as, up to the 10th, that was your warning sign that there was some issues that we might pull back. We didn't know. You can't tell from this that you were going to fall apart, but just saying, okay, you got a little overheated and now you should come back in. So that's how you should use this particular indicator. And now our Webby RSI is back up to a 1. We'll do one final thing and just look at the Bob Marley indicator. And this is just your how many ATRs you are off your peak. The green zone is 0 to 4. Yellow is 4 to 8 ATRs, and the red zone, you want to stay out of that. That's 8 or more ATRs. We were able to snap back from being a little over 7 ATRs off of our highs, back up into that green zone. We want to stay into that green zone. And the same thing with the NASDAQ. We were able to snap back from the red, which was getting a little concerning, more than 8 ATRs off its high, back over here last Monday. And now we're all the way back up into the green zone. So that's what we have for you.
That's going to wrap it up. Any homework? Because I know how you love to give homework.
The homework is, what I would focus on is go through the growth 250. I would sort it by composite rating in descending order and play through all of those, and just have a very, very open mind. about anything, I would flag stocks that look interesting. Now, we've recently added a new feature where you just hit the F5 key on your keyboard to flag things rather than having to drag your mouse up, which drove me crazy, up and hitting the flag button. Now you just hit the F5 key. You can get through the Growth 250 in 15 minutes if you're doing it quickly that way. Then you have all your stocks that are flagged. Those are ones you want to look at in more detail. Put those in a watch list and then unflag them. Don't forget to unflag them. Just put them in a watch list and do a little bit more research on them. That is your homework for the weekend. And have some fun. Get out and walk. Do something cool. Go to the gym.
And hey, after the market gains this week, hopefully it's improving moods all around. Though you shouldn't necessarily tie your entire mood to the market, because that can be a recipe for lots of psychological problems. So
yeah, don't do that. Don't get excited when you're doing well, and try to not get to get too upset when you're doing poorly, because you're going to do well, you're going to do poorly. Just keep it as even keel as possible.
And again, let the market kind of be your guide as to which direction you need to go. So thank you so much, everyone, for joining us. Again, I know it was a long one, but this is what happens when Allie's not here to keep Mike in check. And I just kind of spur him along. So have a great weekend, everyone. If you are able to join us for IBD Live, that's going to be a great show on Monday. We're going to go over an industry group spreadsheet that I go over every week. That's at investors.com/IBD Live. As Mike mentioned, David Keller was on today. Great show. Check that out. Joe Fahmy, I believe, is going to be on next week. So that's going to be, we love having Joe Fahmy on. He's a great guest as well. So do check that out. The podcast, it dropped with Charles Harris. We had some book recommendations. We had a little bit of everything for you, but plenty of stuff for you to do this weekend, but enjoy it anyway. Talk to you later. Bye now.